What's going on, YouTube fam? This is the Wealth Investing Network. Today we are comparing Google, aka Alphabet, with Meta. Now there's a lot going on with these companies. Meta shares recently plunged more than 20%. Meta's Reality Labs division, which houses its VR headsets, Oculus, and Metaverse, they lost over $9 billion in the first 3 quarters. And it's actually a little worse than that. We're going to take a look. Alphabet, or Google, I'm pretty much going to call it Google, they missed on earnings, and we're going to get into all that, but I got to ask you to please hit that like button and subscribe. We're going to do some stock analysis. I'm going to give my perspective. We're going to go through the technical charts, and we're going to get out of here for the day. Sorry if I go too fast, but we're going to start with Meta, the company formerly known as Facebook. I've got it zoomed out to this max chart here because you could see how far they've fallen, all the way under $100, which they haven't been since 2015, 16, in that range. So let's say if you've been investing in this company for the past 5 years, you're down almost 50%, right? That's not what you want to see. They're down close to 70% on the year. It's just all bad news at the moment with Meta because of some of the decisions they made. It looked like they were going to top out around $400, and they decided to do a full pivot to the metaverse. And we're going to get into their earnings presentation. And it's funny, on Meta's website, they say their mission is giving people the power to build community and bring the world closer together. I really don't think that's what they're doing. I really don't think they're meeting their mission, and that's always a red flag for me when I'm looking at a business. To me, they basically have the market share on social media, and they sell ads using your data. And clearly, they're not doing as good of a job of it. When we look at their revenue from their recent earnings report, you see that usually Q4 and Q2 are kind of strong quarters for them. It's a little bit cyclical, so it's not just going to go up and to the right, even when the company's doing well. But what you want to look at is year over year. So when we look at Q2 of 2022, and then we look at Q2 of 2021, you see that they actually declined in terms of their revenue. And then we see this next decline here, Q3 of 2022. And this is in billions, by the way. So you see they made $27.7 billion in the quarter, which is pretty amazing, but they actually made $29 billion last year in the same year ago period. This is always going to make a stock go down. Decreasing net income is always going to make a stock go down, especially if there's no hope for a return or a bounce back in the next, 6 months to a year, right? Facebook is not guiding for that. The only thing they're really guiding for is to spend more and more money on Reality Labs, the metaverse, and those types of things. And revenue for Reality Labs also is getting worse. As you can see, maybe in Q4 of 2021, there was some hope that this is actually going to grow revenue at a decent pace. But as you can see, they made $285 million in Q3 off of this, which you could say it's a lot of money, but they spent almost $3.7 billion on it in a quarter. So look, when you add up 4 quarters of this, right, this is their operating loss. I mean, you're looking at over $10 billion essentially, especially because they don't even factor in, is this net revenue, right? What are the costs that they're spending to get this revenue? And look, companies do this a lot. They really get excited about a project and they will burn through cash to fuel revenue growth for something. But in this case, Meta is burning through cash and you're not seeing the revenue growth, right? You're not seeing any kind of sign that things are going to get better. There's also what people are calling a global slowdown in terms of ad spending online and on social media companies, things of that nature. So you see their average revenue per user going down. And look, I don't want to spend this whole video dunking on Meta because that's not what I'm here to do. There just kind of happens to be a lot of bad news. Something good for shareholders usually is share repurchases, right? Companies buy back stock to kind of reward shareholders, but they repurchased about $6.55 billion during the third quarter. But what was the average stock price when they bought back all those shares? 160, 170? And what about the stock they bought back in Q2 and Q1? That's not a good idea, right? You want to buy back stock when the stock is cheap. And so this really could have been a good thing for shareholders, but it's probably not, to be honest. But they had over $17 billion authorized for share buybacks. They have $40 billion in cash on their balance sheet and not that much debt in comparison. Usually I see those kinds of things and I might become interested in a business. I see like a trailing PE ratio of 10 or so, a price to sales ratio of about 3. These are metrics that on average for the S&P 500, you're going to see a PE ratio between 17 and 20. On average, you're going to see a price to sales ratio of about 2, but it can go a lot higher. So these metrics could signal that companies undervalued, but based on the decisions they're making, it's not undervalued. It might even be overvalued, especially because analysts expect revenue growth to not even really increase that much. In the current year, it's actually supposed to be negative. Next year, they're talking about 6%, and I think this might get updated to be even worse. So if you're not growing your revenue, not growing your earnings, you're going to see more investors heading for the door. They also keep getting punched in the face by Apple. Part of their business is using your data to sell ads, and Apple is increasing their privacy. There's kind of a workaround that Facebook was doing to avoid charges from Apple, and Apple kind of nixed that. And Apple is looking for ways to grow, and one way to do it is to cut down another giant, right, in Facebook/Meta. It might even be affecting Google as well, but I can't confirm that. And look, I don't know if you think the Oculus is a good idea, a bad idea, if you've used it before. I've used it before. It's actually pretty interesting. You might think it's just for gaming. There's actually a lot of possibilities for it. I know they're trying to have it used in the workplace more and things of that nature, but the real problem is it might be a little too early. And if it's too early, Meta might get distracted, right? TikTok is something that's really up and coming in terms of social media space. Reels and shorts are well behind there. Another problem for both Meta and Google is the US dollar is soaring against rival currencies, and that affects almost half of their business at this point. And so Meta actually saw a little bit more revenue growth when you factor out the strong dollar. But Wall Street's not going to reward you for that at all. Now, I don't have the smoothest transition to start back into Google, but one thing I did want to talk about is Google Glass. If you are unfamiliar with this, please go look it up. Google was essentially way too early on an augmented reality project. And now we're hearing a lot more about virtual reality, VR, and AR. And hopefully Google has this project stashed and they can kind of bring it back if it needs to. Google has this whole segment called Other Bets, right? Projects that they haven't spent a ton of money on, that if you're a common shareholder and you're looking through the earnings report, you might not even factor it in. But if some of these things hit, they could be very successful. And that's a different strategy than just going all in on a project that the CEO thinks is cool. Because if Google was doing that during this environment, things would be so much worse. I actually waited a little bit after earnings to record this because they dropped to about $95 during earnings. Now they're down under $90. In the past year or so, they're down almost 40%. And Meta's falling even further since their earnings as well, because we have to talk about the macroeconomic environment, right? Inflation hopefully has peaked, but interest rates are going to continue to go up, which does affect these companies. All right, but let me stay focused and talk about Google specifically. They missed on earnings. YouTube is shrinking. The company said that they were going to cut their headcount in half by Q4. In terms of their Q3 earnings report, Alphabet missed on analyst expectations on the top and bottom lines. Alphabet's total growth of about 6% marked the weakest period of expansion since 2013, excluding one quarter in 2020. So the stock is sliding this week as earnings information is seeping into the market and more bad news is coming out on top of that. And of course, the key is there's kind of a global ad slump right now. I wouldn't say they're doing as bad as some of the companies like Snapchat, where if you're an advertiser, Snapchat might be one of the first things you cut and Google might be one of the last things you cut. But it shows that people are getting to that last rung. Google was sliding yesterday off some bad news that they're pausing enforcement of their proprietary billing system in India after an antitrust order. It's of note that nearly 97% of India's smartphones run on Google's Android mobile operating system. So perhaps there's some leverage there. The government thinks that Google's price is too high. Maybe they come down on the price a little bit. We'll see what happens, but it's bad news at the moment. There's also more news about them struggling to compete with TikTok, but we don't know exactly what TikTok's numbers are because they're not a public company. But we know it's affecting Google because they are trying to lure creators away with cash. I saw some articles about a 45% revenue split, but we don't know exactly what that number is. We do know that they did a big redesign that highlights shorts more, right? That short form content that's similar to TikTok. And big redesigns are a bold move. I actually like the redesign. We'll see kind of what popular opinion is on that. Let me know in the comments if you like it. But they're making bold moves, and I like that. I think some analysts are still bullish on Google, which is good. And management has made a commitment to rein in hiring, and that could cut down on their expenses, which could improve earnings. So speaking of earnings, let's get into their Q3 financial highlights. Like we talked about, changes in revenue year over year, about 6%. Not great. Huge decline over last year where they were growing at close to 40%. If you factor in changes in currency, they would be up double digits, so that's something to note, but Wall Street is not going to give you credit for what you would, could have, should have done. There's not that much to break down on the balance sheet. They have close to $100 billion in cash equivalents, marketable securities. That's amazing. Their liabilities are about flat. They have close to $25 billion in debt, but that's way less than their cash position, so they have good leverage there. Looking for my own personal opinion, obviously these numbers could be better, but we're hoping for a bounce back based on some of the decisions that they're making right now. But one of the major things I wanted to talk about is bring it back to the other bets. They're making about $200 million in revenue off of their other bets. They're taking it on the chin with about a $1.6 billion loss in terms of their other bets. But if any of these hit, that could be a really good thing, right? Like if their internet and TV services really catch on, like Google Fi, if their Nest branded hardware catches on, things they have in the healthcare space, biotech, robotics, any of these things, self-driving cars with Waymo, if any of those things take off, they're going to put that in a separate category, kind of like how Google Cloud is in a separate category, and they can tout how well they're doing in that segment. And if they really need to, they can kill some of these segments and say, hey, we need to stop wasting our money on this. That's a very different approach from a company like Meta that's going all in on reality labs in the metaverse. Now, from a valuation perspective, Google could continue to fall a little bit, but right now they're performing close to average when it comes to the S&P 500 in terms of trailing price to earnings ratio, PE ratio. Price to sales ratio might be a little high, but this is still a high quality company with a market cap of about $1.15 trillion. You're paying a multiple of about 4 on their revenue. That's relatively average. And you shouldn't count out a company with a fortress balance sheet like that. The tough part is, how can they spend $100 billion when they keep getting antitrust scrutiny? Well, my answer would be a dividend. That's just my solution. And while buybacks are nice, a different kind of investor likes dividend stocks. And that's why Apple started paying a dividend. I think Google might be at that stage. And when you look at a business life cycle, how do they make a life cycle extension, right? This is a mature business, cash is up, profit is decreasing a little bit. It'd be great if one of those other bets worked out, but a dividend would be really nice as well. But maybe I'm thinking too out of the box, who knows? Quick look at the technical charts. Like I said, Meta is hitting levels that they haven't hit since 2015, 16. They're on a very steep downtrend. This black line is the 200-day moving average, and the trend is down, way down. So I don't have much for you there. In terms of Google stock, again, a big downtrend is happening. Maybe you could get some relief right before the fall they had in September of 2020. Maybe you could get some relief there in terms of support. There was some consolidation back here as well, but this stock has continued to break through areas of consolidation as well. So maybe a stronger level would be right around where they were before all the panic and fear. I'd say there's a zone somewhere between 70 and 75 where I think you might just run out of sellers at this point, I think. Then again, I could be wrong. You would want some sort of catalyst that would at least get it trading sideways for a bit, and then you would see a reversal. I think you're going to see more slow movements with this, so you can watch it week to week. But that's pretty much all I had on these companies. Thank you so much for watching. I really appreciate it. Hit that like button and subscribe. I've got to go tap into the metaverse. See you in the next video.